Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Brad Dillman, chief economist at Cortland, to discuss the impact of interest rates on the multifamily and single-family real estate market. Brad, it's great to have you with us. Welcome to Trade Talks.
It's great to be with you.
All right, you got it. So we know inflation data is starting to come in a bit. The employment market starting to cool off a bit, although wages are still high. So of course, Brad, the question is, what are your thoughts around interest rate hikes policy? I mean, 1 month of data cooling down doesn't necessarily make a trend. What do you think?
Well, I think the pace that the CPI at least is cooling down is pretty quick. We can look at the Fed funds rate. The market thinks there's going to be one more hike coming up. If we take this to real terms, you're looking at a real Fed funds rate of about 2%. That's the highest it's been really since 2007. There was one brief month there in 2009, but that's a positive real yield, and that's something that investors haven't seen for a while. I think people are going to look at cash yields, say something like a money market, and look what they're getting there, and they really do have to ask questions about whether or not they want to be making certain investments at a much lower yield than what they can get just by holding a superficially less risky asset like cash. I think that is something that the market is broadly adjusting to, and we can see that reflected in some of the trepidations and in liquidity and in some concerns in commercial real estate investment in general, and some of the volatility we've seen in the single family market.
Before we get into annual rents, when we look at the single family market, give us some background on what Cortland does and how you're able to accumulate this data. Where do you fit in the real estate market? Yeah,
so Cortland is a vertically integrated owner operator of multifamily housing. We have about 80,000 units across the Southeast, primarily a little bit in the Northwest and the Midwest. Typically value add, but you can really think of it as being this sort of suburban mid-rise product, 250 units or more, institutional brand, really focused on the resident. Now, the way we get a lot of this data, of course, we are holding all these assets, so we're constantly monitoring our own operations, but we've also invested a lot in data expertise, right? So people like myself and other folks in our data science group, and then just buying data from third parties and aggregating all this and running a lot of analytics on it. So we run our own proprietary forecasting models, and that's one of the ways in which we get to the commentary that I provide.
And Brad, let's talk about the strength of annual rent growth. We know that has been sort of a stubborn part of the inflation picture.
Yes, yeah, it certainly has been, at least as measured by the government. If we look at just conventional multifamily, and let's talk about institutional properties that typically have maybe 50 units or more, we can look to groups like RealPage, where you can see that there's been annual rent growth, at least across the big markets in the country, that's really been slowing down quite sharply. And indeed, the Q2 data that just come out, at about 2.5% across the 780 submarkets that we track through our primary models. It's actually below expectations. So we're seeing this slowdown occur quite quickly. But on the flip side, we're looking at rent levels that have actually started to increase again. It's not too dissimilar from what we see in the Case-Shiller index, right? You can see a big slowdown in the annual home price appreciation rate, but at the same time, if you look at the index level, it's already increasing again.
One of the issues that we have in the US is, besides affordability, is the amount of properties that are available. Do you think the US is closing the gap in terms of being underbuilt? And what's your outlook for that?
Yeah, definitely. So we do think that the U.S. is closing the gap, the degree to which it's underbuilt. We estimate the U.S. is underbuilt by about 718,000 units now. There's a couple of moving variables. There's a lot of housing under construction and nearly 1.7 million housing units. We've also got immigration that's run hot for a bit. It may continue to run hot. It's hard to say. So two variables moving there: population growth and supply. We also know that when sometimes we dig into third-party data about what's under construction, we find that some projects that are considered under construction are in fact still in planning phases. But right now, we would expect that the U.S. will continue to close this gap. It will likely be overbuilt in the latter part of this decade, with various ramifications for the broader economy.
If you had to look at single family versus multifamily, of the two, which is more preferable from an investment perspective?
Well, what I could really comment more on is maybe the consumer perspective. We can all look at mortgage rates at being 7% nearly, and say that on a month-to-month basis, clearly renting provides a different option. But clearly, if we look at the last 10 years too, just the ownership of an asset, the ability to pay down that principal on a mortgage is certainly valuable for the consumer. I think when we peel back the onion, we can look at what's happened in housing is we've really not provided a lot of multi-bedroom heavy product over the last 10 to 15 years. And instead, we've been building a lot of 1 or 2 bedroom product that really doesn't align with our demographics when we think about the aging of millennials and such. So within all this, we always have the calculus, of course, what is an individual doing with their own life, their own family situation, that kind of thing.
When you think about institutionalized housing, it could have a less than favorable connotation to it because, especially younger first-time home buyers, they just can't afford to buy a home, regardless if you're on the East or West Coast, it's everywhere, right? Do you think that exasperates it with institutions buying up a lot of these properties, particularly on the lower end?
I think on the single family side, there's no question that they're competing with would-be end user owners. We actually saw this coming out of the Great Recession too. There's all the non-performing loan purchases through HUD that became the single family REITs in the beginning. There's actually a lot of foreign capital that comes in and will buy single family real estate as well. There were parts of Florida, according to National Association of Realtor reports that had analyzed data. This is about 10 years ago now, but was looking at coming out of the Great Recession. You had parts of Florida that were 90%, foreign buyers. So there is a lot of conflict there. When we look to multifamily, I think one thing that we've done to kind of gauge the impact of institutional ownership of multifamily, and of course we would expect that with 250 units or more, it's a very large and expensive asset. But we've started to see fluctuations in what we call the first-time renter. And one of the things that's really great we've seen when there have been big bouts of mortgage affordability, like in 2021, when the housing market really ripped, we would actually see people move out to own, and they'd be backfilled by people who are first-time renters. The people who've been living at home longer finally had a place to move out, at least independently, even if they didn't own it, as other people moved downstream.
Interesting. All right, Brad, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.